Very good morning, everyone, and a very warm welcome to this month's AMA. And thank you for taking the time to join us today. It's wonderful to have such an engaged community of investors and learners with us once again. For those joining us for the first time, welcome to Factor Lab. We are a quantitative investment research and wealth management firm that believe in making investment decisions driven by data, evidence, and systematic research rather than market noise or emotions. Through our research strategies and educational initiatives through our YouTube, our goal is to help investors build long-term wealth and clarity and confidence. Today's AMA is your opportunity to interact with our founders, Mr. Deepak and Shekhar, to gain insights into the current market environment, understanding how we are thinking and about our portfolios, and get your questions answered live. So I'm delighted to introduce our founders, Mr. Deepak and Shekhar. Over to you, sir.
Thank you, Parnita. So we're going to start the session with market outlook. How did Indian equities perform broadly? And then we will also talk about factors. How did different factors perform in the last month from the time we had the last webinar? And also talk about global markets. That's going to be interesting. Some interesting things happened outside of India. And then lastly, we'll also talk about commodities. So then we'll delve into our small case strategies, both dual momentum and adaptive asset allocation. So let's begin with that. Hope you guys are able to still see my screen here. So if you see within Indian markets, large cap like Nifty 50 did a 2% return in the last month. And then followed by Nifty Next 50, right? So which did about 1.6%. Overall, if you see, the large caps seems to have done well in the last month compared to the compared to small cap and micro cap stocks. So you can see that on a 6 months basis and a 1 year basis, both small cap and micro cap did well, but just for last month we've seen the large cap doing well. And if we go to factors, this quality did about 1.8%, alpha about minus 1.3%, momentum at minus 2.5%. I think the two factor-based indices that did well in the last month would be low volatility and high beta factors. So low volatility, I think it makes sense because the market has been quite volatile in the last month, especially since the war between Iran and US, Israel have resumed again in July. So the markets were continued to be volatile. So hence low volatility index did well. And then looking at high beta. So high beta factor is basically measures the sensitivity of stocks to overall markets, right? So basically measures beta between the stock and the and Nifty 50 index. So they take top 50 stocks with high beta, and that's how this index is formed. And this factor in particular has been doing very well since last 6 months and 1 year. And when we turn to global markets, very interesting to see that, for the first time, probably the last month has been red for global markets, especially South Korea. As you all know, there are concerns about the investments that are being made on AI infrastructure, potential AI bubble, and there's have been a lot of investments made through levered ETFs in South Korea. And as you all know, South Korea's market cap is just made, 50% of South Korea's market cap is made of just two stocks, SK Hynix and Samsung. So the index as a whole has been quite volatile from the beginning, but the last month has been bad. I think it recovered yesterday slightly. So overall, apart from Hang Seng Index, the Hong Kong Index, most of the indices didn't do that great globally. I think the Hang Seng Index as well was struggling before July. So there was some correction that happened in June or even before June. But that was recovering in the last month. So I think one insight that we can draw from here is that since the global markets were uh, have become quite volatile given the AI boom and whatnot. So there is potential for FPIs or foreign investors to turn back to India. And we've already seen that through our data in July. So in July, I think roughly 22,000 crores of investments have happened into Indian equities through FPIs, which is probably the first time that is happening in 2026, right? So up until the first half of the year, June 2026, we were the FPIs or foreign investors are mostly taking out money from the Indian markets. And lastly, when we look at commodities, mainly silver and gold, they are where they were mostly. There hasn't been a significant change. So as you see, like I think before Jan 2026, up until Jan 2026, there has been a massive rally for both gold and silver. But now we've seen that has corrected a bit, and now it seems to be stabilizing overall. And as a result, you also saw that, given that the sustained momentum has reduced for gold, you can also notice that our allocation towards gold has also reduced in both adaptive asset allocation and dual momentum strategies.
The charts might show that there is a good gains or 1.5 to 2% in the overall index. But is it genuinely getting percolated to every stock within the universe is what is interesting. That is when actual bull run will start to happen, when the overall stocks start to do well, not just a handful of stocks. So for that, we need to see the dispersion of the returns. So let me show what I mean by that dispersion of returns. So you're seeing this chart of all the 750 stocks. Each dot actually is one particular stock, categorized by Nifty 50, Nifty Next 50, mid cap 150, small cap, and micro cap. And on the x-axis, you see the percentage of returns that in the last 1 month each stock has given. And the black colored line is the median value. So if you notice that there is a huge dispersion in the micro caps. So that's why I usually say that micro caps and small caps are the place where you need a fund manager or someone to actually pick the stocks, because picking wrong stocks can actually throw up in quite a bit of negative returns, even though the markets are doing reasonably well. And the dispersion actually reduces as you go up in the market cap. That also brings us to the point that in the large cap space, it is actually better to stick with the index. The alpha actually lies in the mid small cap or the micro cap space. Now, our dual momentum actually is positioned in these three parts of the indices: micro, mid, and small cap. Now, within the within each of these market caps, of all indices, the last month Nifty, Next 50 or Junior has done phenomenally well, because you see the average median value of up move is around 2.7%. And you see most of the stocks are towards the right side and very closely clustered around 2.7. So I'll show the dispersion also. So on an average, mid cap 150 or junior 50 has given 2.9% returns in the last 1 month, and Nifty 50 has given 3.1% returns in the last 1 month. Micro cap 0.9, small cap 1.1, and mid cap 1.6. You see the large cap heaviness in the last 1 month returns, and like I showed in the charts, mid, small, and micro cap are just consolidating. Now, also I wanted to show you the difference between the average and median. The average 3.1% is of the 50 stocks. So some stocks which have done really well might have pulled up the average higher. But if you actually plot where is the median lying, or where is the 50th percentile of the stocks, what is their returns, it is at 1. Meaning few handful of stocks have actually pulled up the entire Nifty 50's returns. These handful of stocks have been the IT stocks. Because in the last 1 month, IT has seen a good rebound. And because of that, the Nifty 50 has done really well. And that is why you see a dispersion between the average and median in the Nifty 50. In fact, even the largest dispersion, even seen as compared to the microcap. The junior 50, on the other hand, has been secular. All the stocks have risen together. That's why you see very minimal difference between or dispersion between the average and mean. Very good rally as a sector overall. And microcap and small cap, if you notice these two, the average is showing positive numbers, but the median is showing negative numbers, meaning there were more number of stocks in the negative zone than in the positive zone. That is what you see. The percentage of positives are actually less than 50% in the mid small cap space in the last 1 month. So this is what is actually causing the median to be in negative. Whereas if you see in the large cap space, it is close to 62 to 68% of the stocks doing well and ending in green territory. Now I've run a quick simulation just to highlight why the portfolio construction and selecting of stocks and what is the portfolio size that we need to hold is important, especially when we are dealing in micro small cap space. Because let's take a look at it. So what we're trying to do here is, in the last 1 month, let's say we have randomly created a portfolio of 5 stocks across different market caps. What is the probability that these 5 stocks that we create, that portfolio delivers a negative return? So in the case of microcap, there's a 50%, almost 50% probability that any random portfolio that we construct with 5 stocks can become negative. And in the case of Nifty 50, it is just 20%. So if I increase my number of stocks from 5 to, let's say, 10, this probability decreases to 43% in microcap. If I increase it to 15, it again falls down to 41. If I increase it to 20, it comes down to 38. If I increase it to 25, then it comes down to 36. 30, if I move, that is 33. So 1/3 of the probability from 1/2 to 1/3 we are coming because of when we are diversified enough in the stocks, especially in the micro cap and small cap space. A good example is in one of our portfolio, we had Thangamile and Thermax. It was hitting continuous 10% lower circuits. If the concentration of the portfolio was only 5 or 10, it would have created a havoc in the overall portfolio. But if you see or notice, as Deepak showed in our last 1 month's performance, you will not see that much of a change, even though 2 of the stocks are hitting continuous lower circuits, because they are well diversified. Some of the good stocks are pulling it up. Then there are a whole lot of average stocks which are staying just afloat, and then few stocks are dragging the returns. If you actually see the contribution of our underperformance in last 1 month, it is precisely because of these 2 stocks. Roughly, if a stock is falling 10% lower circuit every day for last 3 days, 30% fall, and each stock has a contribution of 3% or 3.3%. Out of the 3.3%, 30% is wiped away, is 1%. That's the exact difference between what an average small cap index has given versus our strategy. So that's the reason we have a good portfolio of stocks, especially when we are in the sideways or when we are in the lower in the market cap. And consolidations are a part of the game. And when we see the overall consolidations happening in microcap, the charts might look very benign, like they are slanting or sideways. But actually, if you go and pick at a stock level, if the microcaps are consolidating, means there's a huge volatility of some stocks going up, some stocks going down, and the index actually camouflages all this volatility nicely, and hence having sufficient portfolio of stocks is important.
Yeah. Okay. So on one hand, I've selected Nifty Bs, Nifty 50, and the other hand, I've selected REITs and InvITs. So when I actually look at the rolling correlation, right? So basically, each data point is a correlation between the index and between REITs and InvITs and Nifty 50 for the last 1 year, right? So here you see for every year what was the correlation, right? So initially when REITs and InvITs was formed, it was just one or two stocks, but eventually we now have about 6 to 10 stocks in the index. So that's why you see the correlation is initially high, but if you see now, right, so it ranging between 0.66 to about 0.28, right? So the correlation is this correlation seems to be very similar to what we have with global markets as well, right? So if you look at correlation between NASDAQ 100 and Indian equities like Nifty 50, you see a correlation about 0.25 to 0.3, right? Whereas if you see a correlation between large cap and mid cap within Indian equities, you see a very correlation of about a 0.8, right? So when you kind of add uncorrelated assets to your portfolio, you have a more smoother journey. So this rebalance, we've added REITs and InvITs to our portfolio for about 10%. And yeah, so we'll again monitor this and in the next rebalance, we might potentially increase the allocation or keep it as is. Yeah, so that's about our entry into REITs and InvITs. I think we have a question from Vamshi. Can you comment on the stocks in your watch list in the screen you are sharing? Can we use these tools, Shikhar?
The stocks that are on a watch list are the stocks that we have holding in a small case, so can't reveal them yet.
But yeah, if you're using TradingView, you can use these tools.
Yeah.
Yeah.
Hi, Shikhar, Prem. Yeah.
Hi, Prem.
Yeah. Thank you for keeping us posted on the rebalances. I have a quick question, Shikhar. Like now we are heavily invested on two indexes, as you said, mid and small and micro cap.
Yeah.
Suppose if you see there is a change in shift of momentum from out of these two indexes, like suppose you go to the Nifty 100.
Right.
So now we want to take out one of the index, which is existing one. So how are we going? Are we going with a phased manner investment into the new one which is coming, or it's like just close half how much amount we hold as a further index, just close everything and then go in? Because if that is the case, it's a big chunk, right? Churn
Right.
of our portfolio. I just want to check with you since we may not be with the same indexes very much longer, right? So just want to know how it goes.
Yeah, sure. Very valid question, Prem. Thanks for asking. So I'll give an example of how did we handle when two rebalances before. We were overweight on mid small cap 400 and gold. So mid small cap 400 had 15 stocks and gold had 50% weightage. Now, when the gold's signal were showing that it is slowly moving out of trend, the short term or medium trend, we first moved it to 25% weightage and then added the 25% weightage to micro cap stocks. And we again waited for one more rebalance to see if the trend is persisting, downward trend of gold is persisting. Then we brought it down to even further to 10% and then increased the weightage of micro cap to 40%. And finally, after the third rebalance, that is every rebalance happens 2 weeks. So after 6 weeks or 1.5 month, we completely exited. So if we were to do a similar strategy, we'll again do it same way, because based on just one rebalances signal, we will never take a call. And moreover, by the way, as I say, it will still take quite a bit of time for large caps actually to come in the radar. Right now, in our pecking order of signals that we have mid small cap, micro cap, REITs, InvITs, gold, and then large cap. So gold, the large cap have still a long way to catch up, even to come to the level of REITs, InvITs, and then move push REITs, InvITs, and then come to micro cap space. That is one. Even if it happens, then it will be phase-wise gradual shift. We'll wait for at least two signals or two rebalances to say that if it is knocking the door continuously, that hey, I'm coming up, bring me into the table. That is when, after two successive rebalances, we'll first start to reduce the weightage, induct, and then phase out slowly.
That makes sense, because I was worried just how we can just cut it everything and then go to the next index. Right? So that's good. It might be a Nifty 100 or gold, that will matter. So I'm good with that. And the second question I do have, I mean, while you were explaining, right, you have a 30% as a base, where if a stock falls 30% as with buffer of 5 to 10%, you're gonna exit the stock, right? When you do the next rebalance.
It's
Is
not
that
30% actually, it is 30 rank, 30th rank. We have 30 stocks. So all the 150 stocks we rank on certain parameters. So 30 stocks, top 30 stocks we pick. And when we rebalance the next time, some of the stocks may not be in top 30. If you
yeah.
picked, go to 38, 40, 42. Even if they go to 42 also, will not sell off. The stocks that we pick, we give them a buffer rank. If it still stays in that buffer, we continue to hold. If it is going before that buffer, below that buffer, that is when we actually pick a new stock from the picking order.
Yeah, understood. I thought like it's in the percentage of return of 30% or something. So thank you for correcting me. And I have one last question. With this, I wind up. The last one, well, suppose you see if the stock is in rank up to 1 to 10, and after performing well for the next 3 months, if it is falls into 11 to 20, and then, so are we gonna book profits in a partial phases, or it's something like we just only book a profit or loss after it falls from that ranking of that?
The second option. So I'll give you an example of how does. First of all, there is no profit booking as such. We let the stock run as much as it can. So, for example, I'll show one of the ones that is doing well in our portfolio since. Okay, so suppose the stock is there. On that, I'm just taking an example. While our small case has started officially from November onwards, but this was there in our portfolio. When we were running the strategy, this was there in the portfolio. Post its IPO, somewhere around these times, we had picked it up. I mean, it came into our radar. We're holding this till this journey, but at some point it got exited because it took very long consolidation, and this market also were moving sideways, and this got completely exited. Again, it came up at these levels. So it might happen the same thing for us. Let's say as long as it is in trend, we might ride the entire rally. And when it is either showing signs of correction, sideways movement, or signs of fall down, that is when it might get exited, and again we might pick it up. So we'll be trying to scoop it during the uptrends.
Yeah, okay. Because this is something you do when even before the small case. I just want to confirm.
Yeah.
Are we still with the same or not? So thank you for that.
Yeah. Thanks, Tim.
I think we have a raised hand from Dracaris. Okay, looks like question
Hi.
has been answered.
Am I audible?
Yes.
Hey, team, first of all, thank you. Every time I join your session, it's a learning experience. I get to learn something new. Like in today's case, the technical charts which you showed, and the dispersion and everything which you showed, that was a good value addition and learning thing for me. So thanks for that. Quick queries, and forgive me for the cheeky name, Zakaris. Okay. One first question is, when you showcase these charts of different indices, you, I believe what you are saying is that this is these technical indicators or these technical charts, they validate what your strategy is saying, right? It doesn't go into any decision making in your.
No, no. Yes,
Uh,
it doesn't mean decision making. Yeah. So,
okay.
just for the sake of communicating it clearly, I show the charts, like what is happening when we relate it to charts. We can quickly relate it. That's it. So, it is only for explanation purpose.
So when
Understood.
we invest in momentum kind of strategies,
Uh-huh.
it's more of an aftermath or an afterthought that comes up,
Right.
right? So we don't know what kind of stocks would turn up in our portfolio. That's
Mhm.
what this is something that our code comes up with, right? So once we get the stocks and once they rally or once they give the returns, that's when we look at these stocks and try to understand what made them give those returns, right? So it's mostly an afterthought in a quant based strategy like this one.
Okay.
Yeah.
Okay. My second query, thanks. I have just one more query. When you, when I joined initial sessions of when you launched these two small cases, and this is related to dual momentum one.
Right.
You mentioned that you would be comparing momentum across four
Correct.
asset classes. One
Yes.
is mid small cap, one is 100, Nifty 100, and the other two are gold and debt.
Correct.
And if it's a consolidating market, probably it will be 50% equity, 50% gold, or 25 debt, 25 gold, or 50% equity, some combination of that. Or it could be 25 equity, 50 gold, something like that. All
Right.
right. And maximum 100% when there's bull market, 100% equity.
Right.
Okay. And if it's pure consolidation, maybe 50 debt, 50 gold, something on those lines. But
Right.
now you're adding micro cap also to it,
Yes.
right? And REITs again, there's a changes, REITs being added now. So
Right.
what was the back test initially? And if you have modified the strategy, how is the back test looking now? Uh,
Yeah.
please.
Yeah. Sure. So fair question of why we have added microcap and REITs. Let me share. I mean, maybe Deepak also can present some other data, but I'll share my perspective on this.
Please.
So I'm showing you the need for REITs. First of all, I'll talk about REITs. So far in it,
I
I mean,
think
when
we
we
are
were
still
back,
seeing trading view.
I'll share it right now.
Yeah.
One second. Give me a second. Let me know once you can see portfolio. Can you see my screen now?
It's still now it's visible.
Okay. So let me present my viewpoint on REITs and InvITs. So when we were actually backtesting when we were running our strategy of dual momentum before the small case event launched, we did not have such a great industry of REITs and InvITs fully built in with proper liquidity, tickers available at one. I mean, I'll tell the challenge that happened. The REITs and InvITs industry started in 2019 with Embassy, and then Mindspace came. Initially, the restriction was you could purchase only if the minimum amount was 50K. Then they reduced it to 10K. Then again
Mhm.
further they reduce it to you can purchase one unit, and then they made it like in equity, so it is now part of the equity index. In some of the equity indices, actually you will see some of the REITs coming in. Now there are a good 7 to 8 REITs plus InvITs 15, and then there's a separate index of REITs and InvITs. There's now a mutual fund itself being launched by Edelweiss of REITs and InvITs, and NFO will come soon. So this industry is now quite developed with enough liquidity and good trading history available of at least 6 years of data. So once it crossed these hurdles recently, we felt why don't we add it? Now, if we add any index or asset class, it should have some purpose. The only purpose it should have is it should be uncorrelated and be bringing the dispersion in the returns, mean returns of different
Mhm.
indices. Now, when we look at the rolling returns and the volatility, in that sense also Nifty, REIT and InvITs. You see this light tiny green color dot?
Mhm, mhm.
This is the
Yes.
Nifty, REITs and InvITs. It stays aloof from the equities.
Mm-hmm.
All these dots represent either a small cap or market cap index, or could be a factor index. Red ones being the sectoral, and green ones being thematic, and purple color being the market caps. Now,
Mm-hmm.
this green dot is what Nifty reads and invades to. They sit in the left to bottom left quadrant of low returns and low volatility, a good proxy between debt and equity. That is one.
Mm-hmm.
Risk reward space, it sits separately. And like Deepak pointed out, it has a negative or not negative, at least very negligible correlation with equity again.
Mm-hmm.
So when things move in different directions of equity, it stays aloof, especially because the drivers of REITs and InvIT returns are not the FII inflows, not the oil price or the exchange rate, etc. Are the tenants available in that micro market? What is the lease rental for that micro market space? And are we getting the cash flows? That's all it matters for the REIT and InvITs, and it makes a good sense to include in the universe of asset classes. Now, with respect to microcaps, microcaps had a problem of liquidity. That's one of the issues that initially we were hesitant to put our money in microcaps, even though they were doing better in momentum. But of late, we have seen that we have tightened some screws even in microcap space. So the microcap stocks, before entering into our universe of momentum, we have put some checks on the liquidity. What is the liquidity volume being traded of that stock? If it meets that, that is the first check to weed out the illiquid names. And from there, we see what percentage of times in the last 1 or 2 years has it hit upper or lower circuit, and we eliminate those circuit stocks. And then from the remaining bucket, we see what are there in the momentum. And if Nifty microcap is actually doing well, then it first comes into picture. And then within that, we put these stringent filters, which are not seldom applied in large cap or mid cap spaces, but except in microcap. Yeah. So these are the two reasons for expanding the index. Yeah.
Understood. Understood. Thank you, Shekhar. Shekhar, how is the backtest looking once you have done these changes? As in, you must have backtested for quite some time period, right?
Right.
Yeah, backtest is looking much better, uh, actually, right? So when we um, did the backtest with primarily Nifty 500 stocks, I mean, the risk-adjusted return was obviously more than one. This adding microcap and REITs and InvITs has definitely REITs and InvITs we don't have like a long history, but
Yes.
yeah, microcaps we do have some history. So adding that has definitely improved our risk-adjusted return, right? Not primarily, not significant probably the return, but the risk-adjusted return has definitely improved. So that made us add these indices as well.
So I'll show not exact backtested data, because whatever data that we present, we will have to be vetted by Parva, but I'll at least show a proxy to what we did, so it is understandable. So let me add couple of indices just to show the index level. How does this even perform? So let me add Nifty and momentum. Okay. I wanted to just give you a feel of how does even mixing a momentum and InvITs would look like. Then I'll show what are the advantages. I'm just giving a 50-50 percentage. So this is the story. Obviously, the data for Nifty REITs and real estate or this sector is very nascent, but we have it from 2021. Now, okay, this is what is the strategy A versus strategy B. And this is a combination of momentum and REITs in bits versus a pure Nifty 50 strategy. That's the overall point of view of having this. Obviously, 5-year rolling returns, 7-year rolling returns will not make any sense because there is no data. All we can see is 3-year rolling returns. And even the bottom 25th percentile returns of the strategy still handsomely beats the 75th percentile of Nifty 50. That's when we make a call, okay, a combination of these is decent enough to be even included. And that's how we arrive at particular combinations.
Mhm. All done. All done. Thank you. Thank you very much. This was really insightful.
Thank you.
Cool. Think I guess. Oh, okay. We have a
Hi, Vamsi.
Amshi. Go ahead, please.
So this is more like a procedural question. I really appreciate all the inputs given. Very well. So this question is, so I mean, some mutual funds publish like their skin in the game kind of details.
Right.
Like how much of their own personal, like how much of the assets under management or assets under advisory, whatever you call them, is their own self funds, right? So wanted to take your view, like how are you placed? I mean, more to understand as in, do you also invest in the same small cases and on your personal funds?
Yeah.
I hope that's a fair question to ask.
Yeah, definitely. So I'll answer this question. Now, the small cases that we have represented, no, these, if you see, one is a satellite strategy and other is a core strategy. Having said that, at least 80% of our portfolio are in personally, are in other, what do you call, usually do through MFs. The 20% are allocated in these small cases.
Okay.
Yeah.
So yeah, I mean, in our investable lump sum that we do, 80% follows the mutual fund strategies that we recommend, and 20% goes into the small cases that we have published. In fact, even before launching this small case, we have been invested into these strategies. You know, 3-4 years before we launched these strategies, we've been following these same strategies and have been investing to it. So we do have the entire liquidable assets invested through our own strategies.
No, and I recommend the same for others also. And none of the small cases, not just ours, other small cases also should never be a core portfolio or core strategy. Should always be a satellite strategy. A core should be a more solid MF products.
Okay. Okay. Sure. Thanks for that. So even your mutual fund, sorry, just a follow-up question on that.
Yeah.
So even the mutual funds you recommend would more or less be based on the similar concepts or I mean similar philosophy of momentum-based I mean funds which are performing well based on momentum factors. Is that a fair assumption?
No, there actually our approach is completely different there. Trend following usually works on actual tradable securities, individual securities. And mutual funds are an aggregate of these tradable securities, and their risk return profile doesn't usually fall under the trend bucket. And investing in MFs or pooled vehicles using trend usually never works. They always show that mean reversion. So in MF, our approach is completely different. we have certain ranking framework to score each mutual fund that we can definitely walk through sometime. And we did a video also on that, no, Deepak? On our MF ranking, how do we rank MFs?
Probably not.
Maybe then it's a good,
Yeah,
we can do
yeah.
one session then. So we have different methodology altogether for MFs, and we do something called as factor regression to understand whether the fund manager is actually delivering alpha over and above the available benchmarks. So once we have a comprehensive ranking, then we have a universe of top 100 to 120 MFs that itself is in a recommendable basket. Within those 120, there can be passive funds, active funds, there will be debt, there will be multi-asset, different combinations of aggressive hybrid, conservative, flexi cap. A whole lot of funds are there, which are we believe are a good investable set. And among those, we construct based on the risk reward appetite. So when we combine different funds, where does the final resulting portfolio will sit? And if that final resulting portfolio's risk reward appetite is what is the investor looking at based on their risk appetite, their goals, what is the returns that they need to expect, and for their goals, does this combination suit? And then we recommend those kind of funds. It is completely bespoke that we recommend for our clients.
Yeah, so for factor regression, we do have a video on YouTube, but that's only half the story. Like Shekhar mentioned, we we do ranking, and it's much more personalized and customized for the individual that we are speaking to. So, Shi, if you are interested, you can drop an email to us on research@factorlab.in. We can have a one-to-one conversation and take you through what is our thought process there.
Sure, sure. In case you're planning some, yeah, thanks, noted your the mail ID. If you're planning some session, I think that may be helpful sometime.
Yeah.
Sure. Yeah.
So this is the risk reward spectrum of different mutual funds. So when you do a combination of funds, your resultant portfolio would be somewhere else because the correlations amongst them would be different. And we also plot the investor's risk appetite and reward that they're looking at. And then for each quadrant or a grid that the investor falls in, a bucket of funds would be recommended. Yeah.
Okay. So you take the correlation of the returns, like the rolling returns, and then that's how you identify the combinations of funds, is it?
The combinations of funds, yes. And none of the funds will be less than 5 years of existence. At least they should be in existence of 6 years or more for us to even pick in the analysis stage.
Okay. Sure.
Yeah.
Yeah, actually, small thought. I mean, this is not a question, but just a comment. So when I was looking at small cap funds recently, what I've observed is that the longer the duration of the funds, typically as the AUMs increase, the returns kind of come down compared to the recent peers.
Right.
It could be a phenomenon because recently the small cap index kind of rallied a bit. I agreed to that also. Yeah, but even broadly also, I have this feeling. Not sure how correct that would be.
What you said is absolutely right. The small cap actually starts from 250 first to 500. Now, if the AUM it says above 1 lakh crores of a small cap fund, then automatically some of the funds which are having an AUM of, let's say, 10,000 market cap, 15,000 crore market cap would get eliminated. Even if they have to deploy 1% of the capital of 1 lakh, it is 1,000 crores. So they end up in the board seat if the company's market cap is 10K or 15K crores. So what happens is they usually tend to the larger part of the small caps. So the alpha of actually the dispersion that I showed, no, even if they pick stocks also, they'll be they will be still be concentrated bets that they'll end up having, and the juice slowly starts to dry up as the AUM becomes bulkier. Yeah.
Yeah. In
So
fact, when we actually look at mutual funds, we're actually category agnostic. So, as I mean, when we look at a lot of, I mean, when some of the misconceptions around mutual funds is that, there is there is a belief that, small cap fund means higher volatility, large cap fund means lower volatility. But when we actually look at the data, these are some of the insights that we look at. So let's just look at 16 to 18% volatility band here, right? So you see a flexi cap, a large cap, right? A value fund, a mid cap fund, another mid cap fund, then there is a small cap fund, right? So within the same volatility band, we're seeing different categories appearing, and this is, large amounts of data. So that tells us a different story altogether, that, don't go by categories. Go by what is your risk appetite, what is the return expectation that you have, right? And form a basket according to the performance of that fund historically, right? So that's how we look at mutual funds, rather than looking at specific categories. I understand your question is slightly different, but I just wanted to extend
No,
that.
I got it. I got it. Still,
Yeah.
still, this philosophy does help. I mean,
Yeah.
yeah, there are practical limitations, right? I understand you're more looking at how do you generalize any category of the mutual funds rather than sticking to one specific category of the fund, and then you're using that for the
Yeah.
client allocation or mapping, right? So I
Yeah.
understand that point. Yeah, just shared a thought here. Yeah, got it.
Yeah. Cool.
Thank you. That's it from me.
Thanks a lot, Vamsi. Okay, we'll wait for a minute, and if it is a wrap, then we can close it.
Sorry, one more question here. So, I mean, whatever charts or pictures, graphs you are showing, right? Like, are they available publicly, like the mutual fund dots or things like, or
These are all inbuilt tools for our analysis purpose.
okay? Like, do you share it on a website or something? That's what I'm checking.
No, these are all right now hosted on our local,
Okay. Okay, sure.
published. Right. Yeah, please go ahead, Takaris.
Yeah. Just one last query. Shekhar, why you are saying that only 20% of portfolio should go into small case, any small case, and uh, given the amount of diligence you guys have put in, risk reward ratio and everything of your
Right.
fund, especially dual momentum, it is really appealing. Then why that?
So that is our perception driven from certain realities, like in a small case, we are actually trading our the securities that we plan to do, and when we're doing this, we'll incur some of the capital gains, and a lot of churn will happen. There'll be a drag because of this churn, and if, let's say, some dividends accrue, we'll again have to pay some dividend tax on top of it. The same strategy, if I'm trying to replicate in a mutual fund manager doesn't have to pay any of the long-term capital gains, short-term capital gains, any taxes on dividend. As long as they're plowing back the money in the funds, they all compound in the NAV. So if I can find certain funds or active managers or people who can do similar stuff in MF as a vehicle, the strategy might be the same. If the vehicle is MF, you get the tax arbitrage over a period of time that compounds significantly. So while yes, the small case that we try to do is such that it is not the repeated rinse and repeat of what MF is doing. We see that there is a gap in an MF to switch from equity to gold or move to REIT or move to debt. That maneuverability is not there. They'll stick to their own nomenclatures of what they want to do. So broadly, ours actually represents more closer to a multi-asset approach. But we again, we're not boxed in key. in a multi-asset, you have to invest 30% in mid cap, 30% in small cap, 20% in commodities, X% in gold, debt. That we don't do. We have complete maneuverability, and we are confident to achieve some alpha or unique returns. So if our 80% is actually falling down, our 20% can do well. And try to deliver oversized returns or an MF. If we see that opportunity exists, and this opportunity has some role, and for that role, the allocation need not be massive. Even 20-25% also sufficient for it to play. That's the main reason I would recommend 75-25, 80-20.
Yeah, and I think the numbers that Shekhar has quoted are average numbers, right? It also like varies depending on the person, like the risk appetite. Someone very young could look at it very differently. Someone, approaching retirement might look at it slightly differently. But overall, in terms of volatility, these are slightly of higher vol compared to mutual fund kind of baskets, right? So that's also one reason we suggest, having this as a satellite portfolio as opposed to having this as a core portfolio, right? So we have an entire investable sum into small case, and something like a COVID crash happens, right? So you will see a much higher drawdown in strategies like this, compared to like core portfolio with mutual funds, which includes debt, arbitrage, and also flexi cap kind of things, right? So yeah.
Got it. Got it. All right.
Well,
I sorry.
yeah, please go ahead. Yeah.
No. I was just saying. I seriously hope that the kind of strategy the dual momentum is. I seriously hope that you guys are able to open up an AMC soon in future and have a multi-asset fund on these lines. That's it.
Thanks a lot. May I know your good name, Dragaris?
Manish, man. Shekhar, I have been follower of yours from very long back. Before you started, I have been through your Python codes and
Okay.
I've learned a lot from you.
Oh, nice to know.
Grateful
Nice.
for all the inputs you have been providing on the YouTube and on your website earlier. So really grateful, man.
Thank you. Thanks a lot, Manish. Manish Narang, by any chance?
Yeah, man. Yeah.
Thank you. Cool. Hope to do something great sometime in the future, at least to start with. A small case would be a good start, and then slowly we'll see. But yeah, we're pretty confident on the drawdowns on the path that how we can handle and what is the perspective that we can maneuver with small case. But as I still mentioned, the drag on the tax part eats up some part of it, and that's the reason MF should be the portfolio. That's a good way to hedge. Yeah.
Understood. Thank you.
Thank you.
Yes.
So if
Yeah. Please.
Does anyone have a question?
Yeah. Sumit, you're asking something? I'm sorry. I think
Yeah, just one question on dual momentum. Maybe if you can throw some lights on different factors you consider while selecting a stock in the dual momentum. And maybe since you are introducing REITs and InvITs, so will it change the structure of dual momentum, or will it be a safe asset compared to gold, or will it be again fall into that stock bucket of Nifty or yeah?
Oh, yeah. So the way dual momentum works is we first rank the asset classes based on their performance of multi-time frame analysis. The asset classes are Nifty 100 large cap, Nifty mid small cap, 400, then Nifty micro cap third, and gold is fourth, and debt, which is usually either a liquid, the fifth, and lastly REITs and InvITs is the sixth category. Within these, we pick the top three, and among the top three, we give the weightage of 45, 45, 10. The top two get 45, 45 each, and the bottom gets the 10th rank. Earlier it used to be 2. Now we made it to 3 to make it 45, 45, 10. The reason being, when we introduce, especially after this uh, microcaps and REITs, that data that we had seen, no? So the switch doesn't happen quickly. Index, it's a asset class coming to a second position, will come through the third position. So if the third position already gets some place in the strategy, the switch becomes easier because we just already know the stocks or the asset classes, just the weightage increases. And for the second, if it is falling, usually it falls from second to third. Rarely does it crash from second to fourth or sixth. So the transition becomes smooth. For that reason, we have included this 3, 45, 45, 10. And in that 10, gold used to be there. Now gold has been kicked out and REITs and InvITs have come in. So in REITs and InvITs, we have picked up 4. And let's see if REITs and InvITs continue to be in the third position or if they move up, then the weightages will increase and the number of REITs and InvITs included also will go up. Right now, we've just included 4, 2 REITs and 2 InvITs. Now, what does the factors come into while selecting the stocks? One is the trend or the momentum. Second is its volatility. Third is its volatility. Basically, we prefer low volatility ones. Third is the liquidity that a stock is undergoing through. I think these 3 are the ones that we would be seeing. No fundamental factors at all. Yeah, that's it.
Okay. Does anyone else have a question, or can we wrap this session?
Then Vamsi had a question. Please go ahead, Vamsi.
Yeah. So this is a follow-up to your answer previously. So I think when you're speaking with Manish, you kind of mentioned that it's primarily the tax drag for which you suggest the mutual fund allocation, right? But let's say you have some family members with low or zero incomes, right? Then would you suggest, to allocate more to these small cases uh, versus the 80-20 or 75-25 allocation?
So actually, the tax track doesn't depend on the income bucket. So these are LTCG and STCG. So even if they are earning or not earning, these are capital gains, not the income source as slab. In capital
Okay,
gains, we'll pay the tax of 20% or 12.5% if it is 1 year, or less than 1 year, 20%.
no, that's fair. So, I mean, what you are speaking is for a growth fund. So, I mean, to reduce the tax drag, what I also do is I put some money in IDCW, like the dividend paying funds, right? So, where people like, so some money comes as dividend, but till 12 lakhs it is tax free, right? So that part kind of gets tax free all the time. So, yeah, so just asked in that context.
Right. I think still, I mean, if the taxes and the dividends, the brokerage, and apply the same strategy in MF would still be doing better, isn't it? Because all the small costs would add at least 1 to 2% over a period of an year. And if you compound it, that again is a significant alpha. Same strategy being there in assume in the MF space. So if let's say you're an aggressive investor and want, maybe you can increase up to 40%. Yeah, that's the max that we can go about.
Yes, thanks, Shekhar.
Thank you. All right. Thank you. Thanks a lot, everyone. I appreciate you taking time.
Yeah.
Thank